Okay, so today we will see how to mark a point of interest or an area or zone, from where to expect a buy or sell, and how to mark the exact area that gives us the reaction. As you know, last time we studied the logic behind a point of interest, how a zone or area is actually formed. So today we will focus on how to mark those areas properly on the chart. So first of all, the time frame we use to mark our areas in point of interest are the 1 hour and 15 minutes charts. These are the main time frames we use to mark POIs on daily basis. Also, sometimes you can mark areas on the 4 hour or even the 5 minute chart, but we rarely go to the 5 minute. In case the 1 hour and 15 minute charts are not clear, then you can check the 4 hour. But your main time frames are 1 hour and 15 minutes. If you want to mark zones and areas on daily basis, you will do it in these two main time frames. So after this, you have to wait for the market to become imbalanced. When the market is moving in one direction with momentum and volume, when buy or sell orders are being injected, that's when you will trade. So wait for the market to become imbalanced before taking any action. So once the market is imbalanced, the next step is to wait for the structure break. Let the market break structure clearly, either is in a bullish or bearish direction, so you know where it's heading. Only after that break we mark our point of interest. So now you know which time frames to use to mark your areas. Of course, 1 hour and 15 minutes. You also know when to trade when the market is imbalanced. And if the market is choppy, if it stucks between multiple point of interest and just mitigating one after another, don't trade. Just wait for the momentum. Let the market show you a clear imbalance and direction. Let That's me all again the repeat basic for rule. You have to draw your to point, draw of point of interest on 1 hour and 15-minute time frames. First, wait for the market to become imbalanced, then wait for a clear break in traction. Only after that mark your zone, but you are not making some typical supply and demand zones. You are marking the wicks. Got it? Mark the wicks, the exact areas where major volume kicked in, where heavy sell or buy orders were injected into the market. So you have to mark the wicks. You draw the wicks as your point of interest. Now, sometimes what happen is, let's say you have a candle, a bullish candle like this, and there are wicks on both sides of that bullish candle. One wick on top and one wick below. So what do we do in this case? If there's a wick above and wick below, most of the time the market will go up, like mitigate the wick on top first and hit that area and then continue moving up like this, because major volume can enter on the next candle after this wick, which gives us the bullish move. So most of the time we will mark the upside wick of the candle, but sometimes there's no wick at all above the candle. The main wick is below, like this. That means the major volume was injected from that lower wick. The market was dropping, sellers were exiting, and finally buy volume kicked in, pushing the market bullish. So in this case, when there's no wick above and a big wick below, like this, the area you will mark to buy or sell is this downside wick. That's your entry zone. Of course, we will add more things to this later. And now there are some candles that have no wick on top, or in the case of a bearish candle, like this, no wick below and the main wick is above. In that case, we will look for sell trades from that upper wick as price hits that area. And in the bullish case, we will look at the lower wick as soon as the market taps that area. Now, sometimes there are candles with big wicks on both sides. In that case, usually the candle body is very small, almost like it's not there, and the wicks are much bigger. Our major entries will be from the wick, the candle wick. In a bullish case, the focus will be on the upside wick, and if there's no wick at all on top, then our focus will be on the downside wick. But if there's no wick on the downside and only on the upside, then of course our main focus will be on the upside wick, where price will hit and move up. And same goes for the bearish candle. In case there's no wick at the top, then our focus will be on the downside wick. But if there's no wick at the bottom and only at the top, then our focus will be on the top wick to hit price and move from there. After this, when we mark the area, let's say I have marked my area where I want to look for buys or sells. This is my area. Now what's next? This is my buy area. This is my sell area. The market is imbalanced. There's good volume coming in from the downside, good volume coming in from the upside. On the left side, the market has broken a high, broken structure, or broken a low. Everything looks good. Now, my main task is to mark the wicks. So let's focus on that. We have a structure break, we have a market imbalance, we have market imbalance. Now, what do? You mark the wicks on the 1 hour or 15-minute time frame. So suppose if we have marked these wicks on the 1 hour time frame, then what's the next step? We go to the 15-minute time frame. After marking the wick on 1 hour, we go to the 15-minute time frame, and inside that same area, what do we need? We need the last buy or sell candle, which we call the order block. Okay, last sell candle before a buy. If the market is coming down and gives an impulse move like this, then the last sell candle before that buy move, that's what we want to see here. And then this area becomes our strong area. Similarly, if we are looking at a sell side wick, then what do we need inside 15 minutes? Of course, the last buy candle before the sell move. Now, if you are marking the wick on the 1 hour time frame, you have to look for the order block on 15 minutes. But in case if you are marking the wicks on 15 minutes, then you need to look for the order block on 5-minute time frame. Suppose I mark the wick on 15 minutes, I will check for the order block on 5-minute time frame. Sometimes there can also be a breaker block. Now, what's the difference between an order block and a breaker block? If the market moves like this, you may see a sell before a buy, but a breaker block is the last leg, the last structure point. We usually find a breaker block at the top. If there's a breaker there, fine. And if there's an order block there, that's also fine. But at least something should be there between these two so that the area becomes stronger. Sometimes inside the 15-minute chart, you will see wicks just like on the 1 hour. Now, it could be a sell to buy wick. What does that mean? Suppose the market is moving up and this bullish candle forms with a wick on top, then closes here. As soon as the next bearish candle opens, it first drops, forms a lower wick, and then the market pushes up. In this case, we get what we call sell to buy wicks. If you see those types of wicks, then that area becomes strong. Now let's get to the live market and try to mark some areas. First of all, if we come here, let's start with the most recent areas. First, let's look at the point of interest. In this case, the market broke the high. After the high break, there was an imbalance and the market was moving in one direction with momentum. This is the candle with actual volume. The market moved bullish from here. You have a lower wick and an upper wick. Our main focus is the upper wick. The market will hit it and move down. So in this case, this becomes a point of interest. And if you see, the market tapped this area and pushed up. The candle didn't even close for 1 hour. The market gave us a clean bullish move in one direction. Now let's look at some more areas, and this is a tricky price action, so you will need experience and time to understand it fully. If we look at these points of interest, first there was a high break here. Okay, the market was imbalanced. Look here, the imbalance is that the market is moving in one direction. Now, after that, the main thing, look here, after this candle, actual volume came in, which gave us the bullish move and bullish structure break. That volume came after this candle. So what happened here is that seller exited from this point. After this candle closed, you got sell before buy, and this is where the major volume and major orders were injected. That's why our focus is on this upside wick, this exact wick from this candle. Now look, the market tapped this area but didn't close inside it. As soon as it tapped, the market moved up, and from here you can see a 220 to 250 pip move. Now this is a little tricky price action. If you look here, there was another low break after this liquidity sweep. Okay, liquidity sweep happened here. Market broke the low, same thing here. Liquidity sweep, then structure break. So this area is done. Now look here. This is the candle after which major volume came in and market gave a downside move. In this case, this wick here is the key. This will be our area from where we will look for the sell trades. This is the area where your major orders are, the orders that the market has to pick up. Some orders here still need to be mitigated. Now there's a wick above this candle and there's a wick below. But as we said earlier, our major focus will be on the downside wick. And in a bullish case, we focus on the upside wick. Here the market came in, tapped this area and immediately dropped. After that, if we look at the next area, there was another low break here. The market pulled back and here is the last candle after which major volume came in and this low break happened. Now in this case, this wick will be our point of interest, and as you can see, the market tapped this wick and dropped straight away. Even if you had taken an entry here, this would have been a very good trade. No major drawdown, price hit the area and the next candle dropped immediately. Right now it's showing something like uh, 1 to 17 risk reward, but we don't need to target that much. And we also won't use such a wide stop loss. We will cover those things in the more detail in the upcoming sessions. So this was also a valid point of interest. This was valid and this one was also valid. Now let me show you another example. Here there was a low break. After this low break we had this candle. Now in this case the lower wick is almost non-existent and the upper wick is much bigger. Look at this wick and look at this wick. This one is basically non-existent. This was still fine. This was very good and this one was also fine, but this wick is almost not there. So in this case we will use the upper wick, and as you can see here, price tapped this area and after the tap it immediately dropped below. And from this drop we got about a 400 pips move. Anyway, let's move ahead. Now let's look at these areas. First of all, this is our structure point. This was broken. This was a low break. Last sell before buy. Now this wick was left maybe just by a few points, 1 or 2 points. It missed by about 1 pip. Anyway, no problem. We will count this as a missed trade. After this, if we look here again, structure was broken. After the structure break, this was the candle. After this candle structure broke, market was imbalanced and major volume came in. So in this case, look here, the market tapped this wick. As soon as it tapped, we got to see a strong move, about 500 to 600 pips. Same thing here. How did we mark this point of interest? First, we waited for the market to be imbalanced. Market was imbalanced, structures were broken. Then from where the structure broke, from where major volume was injected, that's where we could place a limit order. Now, after this, if we look at this area, what happened here, the market had broken this structure. Now this is an older area. If you check here, the market just about picked the order, maybe slightly missed depending on the broker, but almost the price mitigated this area. Now this is the same area. After that, the market dropped, then pushed back up, and again the market tapped this week and after tapping moved up immediately. So if for some reasons you couldn't catch an order in the market, no issue, and if you did, that's okay. If there's a good trade, you will get it. There was a lot of trade here. This was a sell trade where the market broke. After that, our order was missed, but no problem. The trade here played out well. After that, this sell trade worked nicely, and even this trade from this week worked very well. So anyway, there were a lot of trades, but how to take those trades and how to make them more high probability, we will cover all of that in the next coming session. You need to backtest this again and again. Specifically this part, train your eyes for it. You must train your eyes, and before signing off, let me show you some examples of breaker block as well. Okay, so the drop from this area here too, there was a 15-minute order block, the breaker block aligned with the 1 hour structure. The breaker block was hit and the market dropped. If we talk about the order block, it was here. Or you could even take it slightly here. But the breaker block was here, that's why this trade got respected. So here we had an order block on the 15-minute time frame. The market couldn't reach here. So what did the market do in this phase? It hit the buy to sell wicks on the 15-minute and the market dropped. But in all area we had an order block. If the market had reached here, this would have been an A plus setup. One you could have executed without any fear or without thinking. Same thing happened here. The market went up, then dropped. After the drop, we had a breaker block. The order block was higher. In this case, the market hit the breaker block and dropped. Why did we select the breaker block? Because it was aligned with the 1 hour point of interest. If we add more confluences to this, you will get an even clearer idea of how to mark more A plus setups. Here too we had a clear order block, the market hit it and pushed up. It doesn't matter if your order block is unmitigated. Even if it's mitigated, it can still be respected because there was no deeper mitigation yet. When the market hits it again, that's when you will see the deeper mitigation. Here's the 1 hour area, here's the 15-minute order block. The market hit the sell before buy wick and respected it. Same thing here and here too. You can see more examples in the background, but the ones I have shown you are enough to help you to understand this. Once you start practicing your eyes, once you start practicing, you will be able to read this much better. Your eyes will detect the entries automatically. Okay, so now accept few things that I will surely tell you in the next coming session. 90% of the major knowledge has been delivered to you. Except some psychology sessions and tips and tricks, and one more main thing that I will share with you. This knowledge is very limited. You can only find this knowledge in the Malaysia or in the London, which cost around 4,000 to 3,500 euro or pounds monthly. Now it's all about your execution and your mindset. You will never ever need any course from any trading guru, because this is the most precise knowledge that is available currently, which is limited to very less people. You will never get this knowledge from any retail trader, because they are just buying, selling all day. Remember, don't be a machine gun, be a sniper. Now it's all on you, and it's only you versus you, not you versus market, because you have learned the market and now it's time to conquer yourself and your mind. And I will see you in the next session. Peace out.